Palantir stock has been confusing many investors lately. After the Q3 earnings report on November 9th, the stock declined significantly, and over the last 5 trading days, we saw the stock slightly go up and then back down. As we explained in the previous Palantir video, the main disappointment from the Q3 earnings was a slowdown in government revenue, especially since government contracts is Palantir's biggest reliance and priority. In our video prior to the Q3 earnings release, we reported that Wall Street has been starting to cool down on their interest in Palantir lately, and there were short trades that took place just before the earnings report. Today, we'll talk about what activities there have been with Palantir in the last 5 days since the Q3 earnings report that could explain the confusing state of Palantir's stock performance recently. We'll also look at analyst ratings and if the market has changed its view on Palantir. At the end, we will also cover Stoneco and explain why Stoneco's stock fell nearly 35% on November 17th. Insider trading, more sell-offs than buys. One of Palantir's independent directors, Spencer Rascoff, recently sold $571,000 worth of shares at an average price of $22.86. But this insider still remains very much invested in Palantir, and it only reduced their holding by 9.1%. Over the last year, however, the biggest insider sale was $29 million worth of shares at $18.86 per share by one of Palantir's co-founders, Stephen Cohen. This was Cohen's 69% of holdings in Palantir. On top of that, Palantir insiders didn't buy any shares over the last year. The implication is that it could be that the insiders have been cashing out of Palantir as opportunities and for personal reasons. But it could also be interpreted as the stock being too overvalued in their opinion to be buying any shares at the current price levels. Insiders also receive stock compensation, so they may believe that this is enough in their position. But overall, I would feel more confident if we saw some levels of insider buying and not just selling. Then what were some outside buys? And does Wall Street still like Palantir? On November 15th, we saw Palantir stock climb on 2 pieces of positive news. One of them was that America's largest public pension recently initiated positions in Palantir. This pension is the California Public Employees Retirement System, also called CalPERS. CalPERS manages assets of $496 billion and bought 3.6 million Palantir shares in the third quarter. The significance of this news is that because CalPERS manages the biggest pension fund in the US, they strictly follow their investment strategy and have a strong influence on the companies that they invest in. Their key investment strategy beliefs include having a long time horizon view and only taking risk when they really believe that it will pay off in terms of reward. This implies that CalPERS fund managers invest in companies with the overarching view of a long-term investment time frame rather than profiting for the short term. And if a company might be viewed as risky, CalPERS fund managers take very calculated risk and only invest in stocks that they believe will reward them in the long term. This is a good sign to see the largest pension fund in the US invest in Palantir. New partnership for Palantir with BigBear.ai. Also on November 15th, Palantir announced a strategic partnership with BigBear.ai, which is a leading provider of artificial intelligence, machine learning, big data analytics, and cyber solutions. Palantir's Foundry platform will be integrated with BigBear.ai's Observe, Orient, and Dominate products. Together, the integrated product will create powerful machine learning extensions for the Palantir ecosystem of data analysis. With BigBear.ai's product, customers that use Palantir's Foundry platform will also be able to forecast and perform computer vision, process natural language, and make other predictive analytics with almost no coding. This will make Palantir's platform more attractive to potential customers because Palantir is starting to create a one-stop shop for anything to do with data analysis and forecasting to help companies make better decisions. Another rationale for Palantir's partnership with BigBear.ai is because it would open sales channels for Palantir. BigBear.ai is similar to Palantir in that a big portion of their revenue relies on government contracts. Since Palantir's government revenue had a slower growth in Q3 earnings, this partnership could help Palantir keep a strong foothold in the government space by upselling products to their current government clients and win more contracts with other parts of the government they have not secured deals with. In addition, we heard in the Q3 earnings call that one of the biggest focus of Palantir's management in the short term will be to grow their commercial client base. With BigBear.ai's powerful AI and machine learning capabilities added onto Palantir's platform, there could be more opportunities for Palantir to market their product among competitors to accelerate the commercial space. BigBear.ai announced in June 2021 that the company will go public via a SPAC merger with Gig Capital 4, ticker GIG, for $1.6 billion. On November 10th, BigBear.ai announced that there would be a special shareholders meeting on December 3rd, 2021 to approve of the merger. Once BigBear.ai becomes a public company, BigBear.ai will have about $330 million in cash from the deal, which the company can use to advance its technology, and this could indirectly benefit Palantir through their partnership. Analyst coverage news. On November 10th, RBC Capital analyst Rishi Jaluria downgraded Palantir stock. His view is similar to what we outlined in our previous videos on Palantir. Mainly, Wall Street analysts like Jaluria are worried about the slowdown in Palantir's growth in key governmental business, and also that the increase in revenue from U.S. federal contracts have fallen by half quarter over quarter. Jaluria also noted that he doesn't believe that Palantir's commercial growth that the company reported in Q3 is positive, because it is largely driven by the company's SPAC investments. He is doubtful that Palantir can sustain an annual 30% growth going forward. And on November 16th, one of Wall Street's top analysts, Credit Suisse's Phil Winslow, initiated coverage on Palantir with a neutral rating and a target price of $25. Winslow believes the company has differentiated converged data fabric that enables companies to use diverse data sets, which sets Palantir apart from its competition. Even though he initiated with a neutral rating and a target price that is not far off from the current price, he believes there is significant potential for the company's Foundry product to grow in the commercial sector. He cautioned that Palantir relies on large deals with few customers. However, I think Palantir is realizing this very point and are trying to diverge away from their habit, because we saw in the Q3 earnings call that the company plans to hire 150 salespeople and that one of their goals is to standardize the Foundry platform and create an offering that can service many commercial clients with similarities. This could potentially indicate that they can adopt a higher quantity of commercial clients for a lower price because the offering will be standardized and require less cost to customize. To wrap up, as we reported before the Q3 earnings report, there wasn't too much positive news on Palantir. It appeared that Wall Street analysts and investors had started cooling off on the stock. And it appears that retail investors have also started to follow Wall Street, with less mention of Palantir in Reddit's Wall Street Bets forum. Although there have only been insider sells and no insider buys on Palantir over the past year, and there were analysts that downgraded the stock, there hasn't been any news on doubt about Palantir's product. The only concern has been doubt about Palantir's aggressive growth forecast over the next 5 years and its ability to expand the commercial business and grow the government business at a similar rate as before. With Palantir's partnership with BigBear.ai and other offerings such as Foundry for Builders, Foundry for Crypto, and their plan to standardize the Foundry platform for commercial clients, we are seeing Palantir really leverage their existing technology. Other news about companies we are following is that Stoneco plunged almost 35% on November 17th. The steep decline was following their Q3 earnings report that was released on November 16th. Stoneco reported a 57% growth in revenue year over year, with about $270 million in Q3. So what happened? According to Motley Fool's Nicholas Rossalillo, the main driver of the 35% decline in the stock was due to a write-down on the fair value of Stoneco's investment in Banco Inter. Stoneco had invested a 4.99% stake in Banco Inter in Q2 to try to gain Banco Inter's customers by providing Stoneco's payment platform. It was a non-cash investment worth $154 million at the time. But Brazil's economy struggled in Q3 and Banco Inter stock tanked. This resulted in a loss of $230 million recognized for Stoneco in Q3. Additionally, Stoneco was already having issues with credit defaults and not being able to collect the credit collateral due to a weak collateral infrastructure set up in Brazil. As a result, Stoneco had paused its small and mid-sized business credit product, and there was also loss made from that. Currently, Brazil's economy is appearing as though it could head back into recession, but Stoneco continues to grow at a rapid pace. Even though the stock has fallen due to a struggling economic times in Brazil, Stoneco's business is continuing to expand. This stock can be categorized as high risk, but potentially high reward investment. But for many investors, many will see it as too challenging and not get involved at this point.